All right, day 479 of going live today. For those of you that have not seen the latest podcast, make sure you check it out. That's why we're in Town today, because if you've seen the last podcast I did with Daisy Sebastian, she goes through exactly the top favorite Section 8 markets in the Alabama market because she understands just exactly what are these residents looking for. And they look in Town, they look in Fairfield, they look in Centerpoint because those areas they don't have to drive too far to get to a grocery store, and they're relatively quiet and relatively safe compared to the rest of the Birmingham market. So that's what we're looking at today. And if you are seeing what we're doing, we are looking for 4 bedroom plus properties, single family homes only, and these are properties that have been on the market for less than 7 days. Okay. And that's how we came onto this property on 2922 Devon Road in Hueytown. Now, what's going on here is we're seeing that this property is being listed for $269,900, so $270,000 for a 2,500 square feet home. And if you've been following what we've been doing, right, over the last 12 months, we've been adding properties onto a comparable sales list, one property a day. And we've got down all the properties that were sold in the last 12 months. Then we started tracking the properties that were sold in the last 3 months. And then finally, now we're tracking properties that are coming onto the market because we are looking to stay on top of what's happening in the market. And most importantly, tracking what our properties selling for on a price per square foot perspective. Now, that's important because we're pursuing the BRRRR strategy, right? The BRRRR strategy stands for buy, rehab, rent, refinance, and repeat. And the reason we're doing this is because it's a very scalable strategy because it allows you to take back out all your initial invested capital and rinse and repeat it over and over again. So let's use an example to confirm, right? We typically see properties are being sold for, let's say you buy a property for $20,000 and you spend $50,000 renovating that property. Pretty big rehab, right? And now you're all in on that property with cash out of pocket invested at $70,000. And when you are able to take that home from 70 grand that you invested to $100,000 in worth and value, now you can go get a debt service coverage ratio loan, a DSCR loan is what it stands for, and pull back out 70% of that, the value of that home. What does that do? Well, now you get to take back out 70% of $100,000 in the form of loan proceeds, which means you can now take the same 70 grand that you put in, take it all the way back out, tax free, and put it towards your next deal. And that's what makes this strategy so scalable because the alternative is you saving up money from your full-time job for 20-25% down payment, buying a property, hoping in the cash flows, hoping it appreciates, and then you save up your money all over again. And that's not saying you can't be successful doing that. It's just that it's typically a slower process to scale your portfolio compared to the BRRRR strategy. That's why the BRRRR strategy is so popular. But guess what? What is the BRRRR strategy heavily dependent on? It's heavily dependent on you getting your ARV correctly. And for you to get your after repair value correct, you have to be staying on top of what a property is being sold for every single month. So this property was listed 7 days ago, listed 114.25. And so in order for you to find the comps for your property, 1 acre, you have to understand, hey, what is there a garage here? No, I don't think there's a garage here. Garage? No, carport, no garage. Okay. Carport. No basement, no HOA. Now, for you to get your comp correctly, you have to note down all these details about the property. And for me, I typically write down the closest neighborhood that this property is in. This is in Avalon Park. So I'm going to write that one down, Avalon Park. So next time I see another property that's closest to Avalon Park, I might say, hey, what did that property sell for? So this property was listed in 1, to January 2nd. Is it sold yet? Nope, still not sold yet. And it was listed for $129,900. So it's still on the market, right? So $110 per square foot, it hasn't been selling. So is this probably going to sell for 106? Hey, we'll see. All right, so now I'm gonna note down some general conditions of the home. This property is pretty much renovated. Modern kitchen, modern bathrooms, no work needed, pretty much. Fully renovated, great. Fully renovated, modern kitchens and bathrooms, no painting or floor work needed. Great. So now that I know that this is my best case scenario, if you will, I have to track, hey, if I ever want to make a renovated home to look like this, I need to figure out, hey, what did this property sell for? Because that might be my ceiling ARV, right? And the reason we're tracking what properties come on the market for is because if you understand how 30-year mortgage interest rates are affected by the 10-year yield, you got to understand what causes the 30-year mortgage interest rate to go up and down. The first thing is the interest rate of the 10-year treasury yield, which right now is at 4.56, which is great because it just retreated from last week's high of 4.8. Just came down to 4.5, which is something that we definitely needed. Now, it's also affected by the spread between the 10-year yield and the 30-year mortgage interest rates. Historically, that spread has been 1.5 to 2%. It's gone as high as 3%. That's when you saw interest rates in the 8s, and the housing market essentially came to a halt. But now the spread has narrowed. So that's why you're seeing interest rates back in the 7s instead of the 8s, even though we're back to nearly 12-month highs with the 10-year yield touching about 4.8 again. So these are all critical factors, right? So if you were looking to do the BRRRR strategy and you were doing a BRRRR today, but you might be looking at comps or comparable sold properties that were sold in October when the 10-year yield was at its 12-month low, you might be getting a higher ARV. But if you're buying a property today, properties that are selling or closing today, their sales price might be a lot lower because the interest rate has gone up for the 30-year mortgage interest rates, which drives down the purchase prices. So when you BRRRR that property 3 months from now in April, and you're relying on comps that were sold in January, chances are the January comps are going to be lower for the sold prices compared to September and October when the mortgage interest rates were a lot lower. So that's something you got to keep in mind, right? And that's why you got to stay on top of understanding, hey, what is your risk? What's the channel that you're operating with? And what are the chances of your ARV being incorrect? Because when you go get that loan, right, your lender's going to go ask for an appraiser, and the appraiser is going to get sent out by the lender to evaluate your home. And when you don't get the value of the home that you're looking for, right, meaning you can't get back out all your capital because you got a lower valuation, what are you going to do to challenge that appraisal? You have to provide substantial comps that are sold in the market to justify the value that you're looking for. And as you understand, right, like what is a perfect comp, right? A perfect comp is if you buy this property and the property right next to it that is what you're renovating, and this property got sold, and it was the same bed bath count, same year bill, same lot size, same square footage, same finishes. That would be a perfect comp. But that's typically never the case, right? When you go across man-made borders like these highways or natural borders such as these creeks, you're essentially in completely different neighborhoods. So you really have to understand, hey, what is going on here? All right. So I hope you all have the spreadsheet up. If you don't have the spreadsheet up, you guys can go to affordablehousing.io, go to the get deal analysis tool, plug in your name, email, your phone number, to fast get a copy of the spreadsheet. I didn't make this spreadsheet from scratch. I got it from a few other folks. I modified, I tweaked it so that I can analyze these deals as fast as possible. So let's analyze this deal as is if you were to buy this property on the market. All right. So let's do this. 121. All right. So now this property is being listed for $269,900 for renovations on this property. Let me delete this multiplied by 3 right here in the formula. So that was the first scenario that we did yesterday. So I'm gonna go to my rehab calculator, and I got 3 toilets that I want to replace with high pressure flush toilets in row 132. Don't need to do any other renovations, so I can zero out the painting line in row 86. I got $5 for some landscaping, just this lot of yard work to keep it tidy. And I'll probably just save about $1,500 for the roof, just in case there's anything that I find or I notice. So with a $4,000 rehab, let's see what this property might rent out for. If I go to affordablehousing.com and I go to the owner section and I go to the market rent estimator, plug in the address, plug in my account, I can see that the average rent here is about $1,486 for 25 units within the 3.93 money. 1450 is what I'll put there for rent for now. Now, for my taxes, I can get that from the payment calculator. Obviously, you should double check with your county assessor records before you close, but right now this is 250. Wow, that's pretty high. A lot higher than what we've been noticing. 209 is in home insurance, so I'll do equals 209, and I'm gonna multiply that by 1.2 because I'm assuming that an insurance company is going to view your asset as a riskier asset if you use it as a investment property. That's why we want to make sure we add in a 20% premium in order for us to adjust upwards of premium so that we're being a little bit more conservative with our estimate. Then I'm setting aside 10% of my rent every single month for maintenance. This is money that doesn't belong to you, right? Right? We just got a bill for a roof replacement for $15,000. We got a HVAC stolen just last week, and that cost about $5,000 to replace. Something's going to happen. And if you don't set aside money every single month for these repairs, you will be grossly underestimating your expenses and you will be overestimating your profitability and lying to yourself. So don't be that person. Make sure you put down all this money into a separate account so that you don't make the mistake of overestimating your profitability, thinking you have all this extra money, which is not the case. All right, so property management, I got 10% set aside. I got 5% for vacancy expenses because someone's always going to move out. And if I get this property for 25% down, assuming 2.5% closing costs for 6.8K, $4,000 for my renovations, I got 7.5% for my interest rate. Right now, I'll be financing B4, which is my asking price, minus my down payment amount that was calculated for 25% down for 67K, I'll be financing $202,000. Now, if I rent this property out for $1,450, I'd be negative cash flow because of how expensive the property taxes are. I'd be negative cash flow 12.71%. That's a purchase price of $269. Let's just do $270,000 so I can have easy math. $270,000 with a $4,000 rehab, assuming 25% down and 7.5% interest rate. Okay. Now, what if I lower my asking price? What asking price do I need to achieve in order to reach a 10% target return? Now, I'm not saying 10% is a magical number. I'm not soliciting any investments on this call. I'm just showing you the work that I do every single day to figure out, hey, what inputs do I need to have? What inputs do I need to adjust in order for me to meet the target return? I'll have to buy this property for $73,000 in order to get to my target return of 10.2%. That's $73,000. Now, does that mean you can get a property for $73,000 when I was listed for $270,000? Probably not. But hey, at least now you know what you need to hit because everybody's target return is different. Some people might say, hey, I just want to buy a home in Southern California and I'm okay if it doesn't cash flow because all I care about is just getting my 5% appreciation on this $1 million property. That's $50,000 a year. They might not care about $200 a month. See, then that's why this is so unique to your own circumstances. You have to understand what is your portfolio mix. How do you want to take little chunks and allocate them towards a certain strategy so that you have diversification? And only you will know what your strategy is, and only your investment advisor will know what it is. So that's why, again, it's not investment advice. You got to understand why you're doing what you're doing to justify the execution risk you're taking on. Because what's execution risk, right? It's the risk and chances of your contractor showing up and doing what he or she said they're going to do, right? What happens when your HVAC gets stolen while you're renovating? What happens when your tenant trashes your home? All these factors will matter, and you have to justify what return do you want for your time, your energy, your resources, including your liquidity, to justify the risk that you're taking on. All right. So I hope this was helpful, everybody. My hope is that you copied my homework, right? Analyze the same deal you analyzed today. 2922 Devon Road. This is property on the market. Using the same spreadsheet, right? Go to affordablehousing.io to get a copy of the spreadsheet and put it on your own YouTube channel. Because at some point, someone's going to ask you, hey, why do you think this is a deal? And you can say, I know that this is a deal because I've been spending time for the past 479 days looking at properties every single day, adding to the list. Might that give you some confidence that you know what you're doing? I certainly hope so. All right. I hope you all have an amazing day. I hope you spend some quality time with your family and friends today because that's what life is all about, everybody. Thank you, everybody. I'll see you all tomorrow for day 480.